of all, thank you everyone for joining the webinar today discussing, the current state of the short-term rental industry. We really decided to do this webinar because we know there have been a ton of questions lately just about short-term rentals in general. And given our access to our own data tools, data from friends and partners in the industry, and also just our experience in actually managing rentals, we wanted to host this, what you would maybe call a State of the Union on short-term rentals. So I am going to pass it off to Amir soon, but before I do that, I did want to mention that while, as you can see, Amir has a presentation pulled up and we have planned content, we do want this to be as interactive and as useful for everyone on the call as possible. So with that said, if you do have any questions, like Amir already said, we really do encourage you to drop those into the chat throughout the presentation. You'll either get that answered in chat by one of our team members, Chris. I'll stop Amir at points and ask him questions in real time. And then we can also save some questions until the end and do more of a Q&A session then. So with that being said, please drop your questions in the chat. Thank you again for joining, and I'm going to hand it over to Amir now to get things rolling.
Awesome. Thank you for that, Nicole, and everyone. Thanks for joining. Really excited for this time. I guess it's afternoon for us. We're here in Charlotte, North Carolina. Excited for this time, and we have people from all over the country joining. So thanks for joining this afternoon, this morning, maybe even over your lunch, to just kind of get a state of the union on short-term rentals. So just real quick on myself, I'm Amir Dukic. I am the CEO of Rabbu. We are based in Charlotte, North Carolina, as I mentioned, and we help real estate investors find, buy, and operate short-term rentals nationwide. We do that through a data tool at data.rabbu.com, where you can underwrite any short-term rental, find its revenue projections, find the closest comps to it through market data that we have to allow you to understand how each market is performing, what the amenities are that perform best in those markets. And then we have a marketplace as well, where you can find actual properties that are on market and purchase them to turn them into short-term rentals. We also partner with other, lenders and brokers to help you actually buy the asset. And if you need property management help, we have a management arm that can operate those properties for you. We currently have almost 400 properties all across the country. So we're kind of have a touch point across the whole life cycle of a short-term rental. So excited to speak with you today. As I mentioned, the presentation today will be to cover kind of the state of the union of short-term rentals. So here is the agenda. We'll start off by covering the kind of the state of the union. Again, we'll date things back to 2019 quite a bit in this presentation. And the reason we bring it back to 2019, because 2019 was really the last normal year that short-term rentals have experienced. We all know what happened in 2020. And as a result of what happened in 2020 with the pandemic and a lot of the travel behavior that changed during that time period, 2020, 2021, and to a certain extent, 2022 have been interesting years, and really not normal years, because there's been some, drop off in demand and supply that then rebounded, almost overcorrected to a certain extent, that I think is worth touching on to help people understand why we are where we are in the kind of current state of the short-term rental market. Then we'll talk about some general market trends around regulations and some opportunities that we're seeing. We'll jump into amenity insights. And what we mean by that is, what are some amenities that you can add to your properties that will actually help those perform better than the market, especially as we start seeing more and more supply come up on Airbnb? What can you do to make your property stand out? We'll then talk about the state of the economy and if it's now the time to invest into short-term rentals. And then I'll cover a few of my favorite markets. And it's interesting, I've definitely seen going through this list of attendees mentioning where they are located and where they have properties. There's definitely a lot of markets that are in my favorite markets list already represented. So that's great to see. Again, one last time, as Nicole mentioned, we highly encourage everyone to ask questions throughout this presentation. I will try to make time throughout the presentation to stop and answer any questions that you guys have. Would love to clarify anything where I may not have been detailed enough. If not, we can also save questions for the end, but I would love to make this as interactive as possible. So please send questions our way as we go through this presentation. Hope this makes sense, and we'll get started. So to kick things off, we'll talk about, again, the short-term rental snapshot where we are now. And I'll actually start with a quick executive summary on the current state of the market. And then I'll provide some details, some data to kind of supports these key takeaways. So as you guys know, the pandemic in 2020 really caused a tremendous drop in supply in short-term rentals because everybody was stuck at home, wasn't traveling, we were all on lockdown. That started changing in late 2020 and into 2021. Demand for short-term rentals grew tremendously because now people were allowed to travel again, and they were utilizing short-term rentals because they, at least initially, provided kind of that socially distanced way of travel. So the demand for short-term rentals grew tremendously starting in 2020 and then beyond into 2021, 2022, and is continuing to grow in 2023 as well. So demand is not slowing down. We'll show some of the kind of data that supports that. On the other end, though, supply is actually now, for the first time in a while, starting to outpace demand. So when COVID hit, supply dropped off tremendously, stayed kind of stagnant. We have some numbers that will show you this. But over the last really 12 to 18 months and going to 2023, supply is outpacing demand. So now that supply is outpacing demand, more properties are coming live, and people are looking for additional properties. That by nature is causing some revenue to drop for hosts. The one thing, however, that we can say from data and everything that we've seen is that great properties in the right locations that have the right amenities, that are serving the right guests, and that are operated properly are performing really well, and they're going to continue to thrive even in kind of a time when supply is higher than it's been really ever. And the way we're kind of looking at the space right now, and from our vantage point, what's really happening is that short-term rentals are in the process of being professionalized. No longer is it going to be the case where you can just take some photos with your iPhone on a random property that you have and put in Airbnb and expect it to generate a lot of revenue. It's really going to come down to actually operating it the right way, setting it up the right way, providing them the right guest experience, and really buying the best asset. So I'll cover all those data points here as we go through this presentation, but I really want to kind of set the tone of kind of what we're seeing in the marketplace. Hope that makes sense. And yes, we saw a couple of questions come in. This webinar is being recorded, and we will share it afterwards, right, Nicole? To those who attended, we'll share a copy of this.
Correct. Yeah, it'll go out shortly after we conclude.
Awesome. So let's start getting into our first data points. The first data points we're going to use to kind of show you guys some of these takeaways that I just talked about are Airbnb's Q4 earnings. So Airbnb, being a public company, just had their Q4 2022 earnings call a few weeks back, where they talked about how the company performed over the last quarter and compared to the prior years. And what they reported on was really from more of a global perspective, so not just the United States, but globally. And globally, their data was telling them two things: travelers are still looking for stays, and owners are still looking to host. So supply is growing and demand is growing. In fact, in Q4, their revenue grew 24% year over year compared to Q4 of 2021, and helped Airbnb have its first profitable year ever. The number of nights booked also grew over 20% year over year to 88 million nights booked in Q4 of this year. So again, more nights were booked this year than they were last year, like in 2022 than in 2021. The one thing that's interesting, and that starts kind of showing some of this trend, the average daily rate, though, dropped 1% between Q4 of 2022 and 2021. So, more properties were booked, Airbnb made more revenue, more people had more stays, but the nightly rate actually dropped a little bit. And this is the kind of the first sign that we mentioned of the supply kind of putting some downward pressure on the nightly rate to be earned. And then finally, speaking of supply, globally, Airbnb ended 2022 with 6.6 million active listings. That's a 16% year over year growth. So they saw 900,000 new listings go live last year, which again is quite a bit of a demand growth, and is definitely impacting things across the board globally. Locally in the United States, we're actually going to show you some data from our friends over at AirDNA. We were part of a conference with them a couple of months ago, and they had this chart that they were nice enough to let us borrow and use for this presentation. So basically, I think this chart does a really good job of telling the story of what happened with short-term rentals and the supply and demand since before the pandemic. So to kind of walk you guys through that, you'll see in 2019, there were right at 1.2 million short-term rental listings. That was growing 16% year over year, number of nights available. Demand was growing 20%, was growing pretty stable with occupancy in the 50%, 53%, daily rates in 210, and really a revenue per available night being in the 112 range. So revenue per available night was growing 4% year over year from 2018 to 2019. Really, that was kind of the standard. What you'll see here is the pandemic happened and the number of listings dropped off significantly. You'll see it went from 1.2 million to a little bit over 1 million listings. So had a nights available drop by almost 16%. Demand dropped because people weren't traveling. Occupancy didn't change much, dropped a little bit. Average daily rate was actually higher, was 10% higher, and RevPAM was actually 8% higher in 2020 because the decrease in supply really helped that. Going to 2021, supply actually stayed relatively flat, but demand jumped tremendously. So you'll see demand jumped 20% over a year as a result of the jump in demand and the low supply. You saw that the actual occupancy jumped to 60%, nightly rates jumped by 12% to 60%, and overall revenue per available night jumped by 28%. As that rolled into 2022, you saw supply actually jump by 25%. Demand was still growing, was still up 20%, but you're starting to see here that the supply was outpacing the demand, which then resulted in occupancy dropping, but daily rates were still higher than prior years, and revenue ended up being about 2% higher in 2022 over 2021. What's being forecast into 2023 is a little bit of the same. You'll see the number of the supply is going to go up. We're projecting 9% supply hike in 2023. Demand is going to go up by about 5.5%, so still continuing to grow, but that's going to cause downward pressure on occupancy while the average daily rates are going to go up. A lot of that has to do with inflation. Overall, the revenue in 2023 is projected to go down some per available night across the short-term rental industry. And the biggest reason, again, for that is the influx of supply. It's just outpaced the demand that was created and the performances that were created in really what you'd call 2020, 2021, and 2022 really irregular years, in the sense that one was deeply impacted from a supply perspective and a demand perspective, but by COVID, and then the kind of recovery, almost overreaction from a recovery perspective, people traveling again, seeing a significant influx in demand that is now starting to stabilize across the board. Any questions? And I'm not sure if any questions have come in. I hope that makes sense for everyone. It's really the supply demand for the market is evolving. All right. I don't see a lot of questions come in, but hopefully that's helpful. With regards, and I wanted to use another data point from AirDNA because, again, this is great data and something that we've been able to confirm with our own data. You'll see here how in 2022 the supply and demand side has evolved. So across every market, so you'll see mid-sized cities, rural cities, large cities, vacation destinations. You'll see in all markets the supply is actually exceeding the demand. So the influx of supply across the board is exceeding demand for short-term rentals, meaning that, again, just by the basis of having additional supply, the demand and the prices are going to get compressed because people have more options to choose from, and as a result are going to try to get the best deal possible. Now, that all might sound negative to a lot of people. We don't think it is. We think it's just the normal process of a asset class being professionalized. And we still believe there's plenty of opportunity for investors to generate returns on their assets. So I'll give you guys an example of that here. So this is a example in Charlotte, North Carolina. So we have, as I mentioned, we operate properties nationwide, but most of them are in Charlotte. We have a little bit over 100 properties in Charlotte that we operate. So I want to use this as a kind of case study for the opportunity at hand. So this is based on data on our site, data.revolut.com. you'll see there's about 1,700 properties in Charlotte that are short-term rentals. On average, they make about $24,000 a year in revenue. The top performers, the top percentile of the properties in Charlotte actually perform 40% better and make $35,000 a year. They actually charge almost the same nightly rate, but have a significantly higher occupancy. And these are properties that have, better reviews, continued strong occupancy, and a good number of reviews. And they're all for entire homes only. So we're seeing that good properties are always going to outperform the market. We also have properties that are in line with these that we're showing here that really jump out too. There's an asset in Charlotte that is an amazing location, close to downtown, close to the stadium, close to really anything that anybody would want to experience if they're visiting Charlotte. That property is on pace. It always earned over $80,000 a year because of its location, because of its amenities that it provides, and because of the way it's operated. So it's really kind of the supply shouldn't scare people off. Yes, it's going to provide some compression, but if you operate your properties appropriately, there's still significant returns to be made in the short-term rental space. You just can't put any property up. And that's really kind of what our summary is. Our takeaway from the current state of the union is really supply quality is going to have to increase. And not every property is going to be a good fit. You can no longer just list a property on Airbnb and hope that it's going to generate your revenue. That's been done too many times. And not only the good ones are going to thrive and really thrive. Hosts are going to have to start operating more professionally or outsource to professionals. Again, what we mean by that is you're going to have to start taking advantage of all the pricing strategies that are available to you. You're going to have to start listing on multiple travel agencies, OTAs, and Airbnb, Vrbo, HomeAway, wherever else the case may be. You're going to have to start making sure that you're getting consistent 5-star reviews, things of that nature. Really operating this as a professional entity are going to matter going forward. And then, as the market stabilizes, we do expect returns to drop, especially with, the current interest rates that we're seeing in the market. But, short-term rentals are going to, especially the good properties, are going to stay really lucrative, especially compared to long-term rentals. So again, return compression is likely. There's a lot of factors at play. Supply is one of them. Interest rates are another, but it's still a very lucrative strategy for your real estate with the right asset and with the right operations. Nicole, any questions that are popping in that we can answer before I keep going and jump into market trends?
Yeah, I think a good one that you can answer now is just what are some ways to actually increase the quality of the rentals that people are hosting, kind of to speak to what you were saying of these high quality operators will continue to prevail?
It's a great question. There's countless strategies. We'll cover some of the opportunities in a little bit when we talk about the amenities and what can be added to that. Really, the guest experience is always number one, regardless of what it is. So the way you kind of interact with the guests that are staying in the properties, short-term rentals are so review specific. One bad review can hurt you tremendously. So going above and beyond for guests always pays dividends. So that's always the first thing you can do. Make sure that the guest has a seamless experience from the onset. That will lead to best reviews. Eliminate any kind of potential pitfalls early on. We've seen a lot of horrible experiences with short-term rentals. Most of them start actually with check-in being difficult. So as much as you can over-communicate early on to ensure that you have that 5-star review, that helps tremendously. But certain amenities, we'll cover those in a second, actually, and provide you guys with some tools to further dive into those. Cool. Let's keep going. Let's talk about some market trends that we're seeing. So beyond just the supply and demand aspects, what are other things in the markets that are worth noticing? And this is a heat. Oops, went too far. This is a heat map that we borrowed from another data provider in the space. Their name is Revvity. Check them out. Great data provider as well. This heat map, what it does is it shows you how local regulations have evolved over time and the areas where regulations are being implemented in these days, right? When anything you always hear about short-term rentals, like, okay, be aware of the local regulation. And a lot of the trends that we're seeing on the regulatory side is really around registration and some slight regulation. What I mean by that is there's not a lot of flat out restrictions of short-term rentals in markets. A lot of times it's, hey, we need you to register your short-term rental so that we can monitor it. There's a lot of, hey, we're going to put X, Y, and Z rules into place to make sure that these properties and these, are actually kind of pillars of the community and not an eyesore. So it's continuing to evolve, but it's really turning to be more on the positive side, and we'll talk a little bit more about that here in a second. Cities are also increasingly requiring occupancy taxes to be collected by short-term rental platforms like Airbnb, and that honestly is a great sign for hosts. If cities continue to do that going forward and start turning short-term rentals into revenue generators for them, that's only going to make them more likely to pass favorable regulations, because they will not want to really kind of cut off that stream of revenue for themselves. And lastly, one great way to really combat restrictions is through midterm rentals, so stays of 28 plus days, monthly rentals. Over 20% of Airbnb's bookings that they see on their platform, they mentioned this again in the Q4 call, are for over a month plus. So there's significant demand for really monthly rentals, and there are very few restrictions across any municipality that prevent short-term rentals. That prevent midterm rentals. We actually have markets that that's all we do there when we operate them. We operate them as midterm rentals. One, because that's required by the local municipality, but also two, there's significant demand in those markets. So take advantage of midterm rentals to really kind of provide a safe zone for yourself when operating, short-term rentals, furnished rentals.
Yeah, I'm going to pop in real fast with a question about
please.
midterm rentals. So in the markets that we actually operate midterm rentals only, is there a drop in revenue or a change in revenue that we see by only deploying that type of strategy?
Really, there's not. It's a little bit, it's unique in the sense that it can be a little bit more create a little bit more, I'm trying to find the right word. It makes investors a little bit more nervous, because a lot of the monthly rentals happen within, 2 or 3 days before booking. So there's a little bit more angst, might be the right term, right? But from a revenue perspective, over a 12-month period, we've really not seen a significant drop off between, short-term rentals and the monthly midterm rentals. It's just that sometimes there can be just a little bit more nerves involved, because again, not a lot of times do people book monthly rentals too far ahead of time, like they do with, short-term rentals. Sometimes they'll book months and months ahead of time. We see, midterm rentals to have a shorter booking window, to be sometimes a little bit more reactionary. But from our data points, we have not seen any true drop in revenue between the two of them, especially if you kind of extrapolate it out through a 12-month period.
We have another question that actually is a follow-up on that. So regarding midterm rental and short-term rentals having similar 12-month revenues, do you believe that to be true for all market types?
Probably not true for all market types. We've seen that to be a significant success in more urban markets. In vacation markets, that may not be the case across all vacation markets. I think you can confidently say that's more the case in urban areas. Vacation areas, I think it's a little bit more of a hit and miss.
And then we'll cap it off with one last question on midterm rentals. I know we have a few more that we'll answer in the chat, but could you answer kind of what type of tenant or renter is actually looking for midterm rentals?
Yeah, there's all kinds of them. Like you guys are looking at one as you speak. Not myself. Nicole is a midterm renter. That's also, well, that's not all you do. I guess you do have a primary residence, Nicole, in Chicago, but it's really a combination of young professionals who are really works at companies where they can work remotely, and they're taking advantage of that ability, and they're traveling to different parts of the country, staying at different short-term rentals for a few months at a time. Nicole's doing so right now. You're in New Mexico now, then going to Colorado, and then probably going home to Chicago for a little bit. And you just bought your first midterm rental as well, right? So that you're utilizing yourself. So it's a lot of this nomadic lifestyle. So that's one large use case. Another large use case is families when they're in between homes, or first moving to new cities, they need a place to stay. So that's a large use case as well. There's a lot of corporate, more traditional corporate use cases. So you'll have an executive of one of the kind of Fortune 500 companies in that metropolitan want to stay at a short-term mid-term rental versus at a hotel. We see a lot of people that are temporarily displaced by events at their house, whether there's they're doing some construction or something along those lines, so they had a fire. There's a lot of insurance claims for people are placed in the midterm rentals, and then of course there's the travel nurses as well, that are famous for utilizing midterm rentals. They're great, probably on the lower kind of ADR range, but still they're reliable, great tenants. All right, let's keep going. So key takeaways just on the market from our perspective is look for markets with limited seasonality and regulatory risks. Drive to destinations have always been the high performers. Drive to destinations being places that are within a 2 or 3 hour drive from large urban markets. So, from Charlotte, where we're based, anything kind of the mountain range in the mountains, from Atlanta, anything in upstate New York or the Georgia mountains, really kind of places where you can drive to from a large metropolitan. Those historically have always performed well and had some of the most stable revenue per available night across their portfolio. And then some on our end, we believe that some regulation is good, and it will be a part of the professionalization of short-term rentals. And what we mean by that is, we believe that, regulations should be set up going forward to make sure that short-term rentals are a good for the community, right? And that they eliminate those groups who plan to have short-term rentals, really the bad apples that are going to allow, house parties and things of that nature to happen. We believe some smart regulation will be mutually beneficial for all involved, and honestly will help with some of the supply that we're seeing. So we believe that's good. We believe it needs to happen, and we believe it's going to happen as part of the professionalization of short-term rentals. Let's jump into amenities real quick. I know we got some questions coming in now, which is great. So I'll try to cover these last few slides pretty quickly, but let's talk about amenities, because I think people always care about what they can do to make more money. So really, there's no one size fits all kind of rule from an amenity perspective. But a general rule of thumb is that, hot tubs perform really well in mountain destinations. Pools usually perform well in vacation and beach markets. And then, having the ability to provide parking or having the ability to allow guests to bring pets is a way to do really well in urban destinations. So kind of quickly dive into each of these. So show you guys a couple of examples. This again is from our site, data.rublu.com, from the market data tool. You'll look at how the amenities affect revenue for each of these markets. So Black Mountain, that's for those of you unfamiliar, it's in the North Carolina mountains. Places there with hot tubs bring in about $31,000 per year. Places without a hot tub, with a hot tub, bring in $58,000. So, you make $27,000 more by having a hot tub in Black Mountain. And you'll see the key advantage there is that, very few actually have hot tubs. Less than 28% of properties in Black Mountain have hot tubs. So if you're looking at Black Mountain as an opportunity, you realize that adding a hot tub will actually be a great ROI on your investment and could actually make or break the deal. So adding a hot tub would be a great amenity there. Likewise, in Gatlinburg, properties, without a hot tub make about $21,000, with a hot tub make about $50,000. You'll see then too that, almost 80% of properties in Gatlinburg have hot tubs. So really having something without a hot tub is a non-starter if you want to perform. This data also likely tells you that it's smarter to look for an asset in Black Mountain and add a hot tub there, because you'll see increased returns there and you'll stand out from the competition there by adding that amenity. And that matters in the long term as you look into working off some of the supply change that's happening right now. On the pool side, we'll use Ocean Island, North Carolina as an example. You'll see properties that without a pool in Ocean Island make about $53,000. Those with a pool make about $64,000. And 64% of them have pools. So it's almost expected in Ocean Isle to have a pool, and you really need one if you want to optimize for revenue. Same is the case in Fort Myers, Florida. Without a pool, you bring in about $24,000. With a pool, you bring in $38,000. Half the properties there have pools. So it just allows you as an investor to know, okay, these are the amenities that I need to continue performing, and this is how the market is doing there, and this is how I can differentiate myself. To talk about the urban destinations quickly, Chicago, where Nicole's from, not having parking, you can generate about $40,000 or $39,000 a year. With parking, your revenue jumps $10,000 a year. And you see only 39% of properties there have parking. So you really, if you're looking for a property in Chicago, you want to find something that has parking, because that's a great amenity that you can provide to increase your ROI. Likewise in Charlotte, if you don't allow pets in Charlotte, you make about $22,000 a year. If you allow pets, you're going to make about $28,000. So again, allowing pets, which only 41% of the short-term rentals there do, allow you to stand out, allow you to generate $6,000 more in revenue, also allow you to charge pet fees to cover some of the costs that you're going to experience from having pets there. But there's a lot of opportunities to kind of identify what the missing link in your market is from an amenity perspective. So you can add that and see how much of a delta in revenue you can generate. All this data is for free, is available for free at data.roblu.com. We are in the coming weeks, including a few more amenities that you can search through to kind of do a deeper dive into what the best amenity for you is. So be on the lookout for that as well. Saw a question on if you should charge for pets. Our usual recommendation is to charge an additional fee to clean after the pet. It just takes more work. There's just no doubt about it, especially the pets that shed. So definitely charge a pet fee, because your cleaner is going to want to pay for is going to charge you for it, and it's going to take additional work. One quick anecdote to that. Don't allow pet pigs. At one of our properties, we allowed a pet pig one time, and it was the worst experience ever. So no pet pigs. Another takeaway from this. Hopefully, nobody else ever does that too. It was an emotional support pet pig, for what it's worth, but it was a nightmare. Awesome. Let's see how much time we have. About 15 minutes or so. So I mean, we want to get to all these questions still. So I'll go through the last few slides relatively quickly. Is now still the right time to buy? Quick answer is yes. If you can find the right asset, and you can use tools like Rabbu or AirDNA or any of the other data tools out there to kind of confirm your numbers and get comfortable with your underwriting. Right now is still a good time to invest. I think you can make an argument that there's less buyers out there, which can help with some of the prices on the assets you can buy. Now, of course, interest rates are higher now than they were 12 and 18 months ago. So again, that's going to drive down some cap rate and your returns a bit. But it's still a good time to buy for the right asset. The demand is still there to service it, but it just takes more time to find that asset. And there's always the opportunity as well in the future to refinance. If and when interest rates drop, you can refinance your asset and kind of unlock additional returns on your investment. We did have a question ahead of this call asking us kind of what are the key stats that we're seeing right now on from a return profile perspective. And again, as you guys can imagine, these have changed over the last 12 to 18 months because of the rise in interest rates, but we're still seeing mid to high single digit returns on both the cap rate and the cash on cash return perspective. Now, 12 and 18 months ago when the interest rates were, 2, 3, 4%, those would have been easily in the double digits, but it's just not the case anymore. And considering that long-term rentals and other asset classes are seeing cash and cap rate returns of 4 and 5%, this is still a really attractive asset class to deploy your capital into. Again, not as great as it would have been from a return perspective 12 and 18 months ago, but that's just par for the course of what we're seeing in the current economic times. We are still seeing deals where you can get double-digit returns on both cash cap rate and cash on cash, but it's just not as frequent as it was again when interest rates were in the 3% range. Finally, the interest rates that we are seeing right now are in the 6.5 to 8.5%. A lot of those would be on like a DSCR loan where the lenders would utilize short-term rental data from us or from AirDNA or from somebody else to underwrite the assets. So you're seeing interest rates in kind of that 6.5 to 8.5% range right now. But again, everybody believes that those will drop in the future, at which point it would be opportunistic to refinance to a lower rate and increase these returns here.
Yeah, I have a question on that interest rate and kind of the financing piece there. Do we have any tips on how to actually secure those types of short-term rental loans, like you're talking about, like DSCR loans or any other short-term rental specific loans?
Yeah, highly encourage anyone who's interested to reach to us directly, and we're happy to connect you. There's a growing number of lenders who are providing short-term rental specific loans that are utilizing our data and data of other groups to underwrite those loans. A couple off the top of our heads are the lenders. One of them, the Host Financial is a great broker. There's a couple more, Chris, that you've been talking to, I know as well. But there are groups out there. We're happy to connect everyone to those if they need a lender, especially on the DSCR side. The other option that we've seen a lot of success with is to go with your local banks where you might already have an existing relationship. Those are usually good to work with, especially a credit union. Those have been pretty flexible in accepting, short-term rental revenue as for their loans as part of the underwriting. So there's definitely opportunities out there, and they're growing. And if you need any assistance of that, feel free to reach out to us. We can connect you to the right groups. All right. And then just to kind of finish it off, we'll talk about some of my favorite markets because we get that question a lot. Again, what you'll see a lot here is grab to destination. So we're based in Charlotte, North Carolina. One of our favorite markets is really anything adjacent to Asheville, North Carolina, and the North Carolina mountains in general. Now, Asheville would have been ideal to be a short-term rental market, but there's some restrictions within the city that are being questioned by the North Carolina legislature. But to be safe, anything adjacent to Asheville is a great opportunity. And in the North Carolina mountains, again, drive to destination from Charlotte, from Raleigh, from Virginia, and even from Georgia and Atlanta makes it a highly appealing market. So Asheville adjacent in the North Carolina mountains are great. Same thing with upstate South Carolina, kind of right between Charlotte and Atlanta. Great opportunities there. With Clemson University being close by as well, certainly helps. Georgia mountains, great gem of a market. Places there perform really well. Up and down the coast in North Carolina, South Carolina, also great. Of course, you have to be somewhat careful. Myrtle Beach, while good, there's some saturation there. Charleston, there are some strict restrictions in the city itself, but if you can find the right asset along the coast, you'll see good performance there. Of course, anything in Florida is great. Florida is just a short-term rental destination, so Florida is always high on the list. From the Panhandle down into Miami, good opportunities there. And then we continue to see really good returns in Central Texas, really Texas Hill Country, and kind of is anything drivable between Austin, San Antonio, and Dallas. That those areas perform really well, and we anticipate them performing well going into 2023 as well. That's it from us, guys. Hopefully this was helpful. Obviously, love to answer any questions that you may have. So please send them our way.
Yeah, great. Thanks for that presentation. I do have a few questions queued up that we can start with, but as Amir said, please continue to send through the questions and we'll get them all answered today. So to start off, do you have any thoughts on very high-end short-term rentals, maybe in the thousands of dollars RevPAR range? This person is asking because they believe that there might be a huge opportunity there that even hotels can't compete with.
Absolutely. There's some really forward-thinking operators out there that are going above and beyond in building assets that just jump out at you. And that from everything we've seen interacting with those groups, they're performing exceptionally well. Now, the hardest thing about assets like that, they're hard to underwrite because you really are setting the market yourself, right? You're creating an experience, an asset type that nobody else may have in the area. And that's honestly a lot of times a positive, and from everything we've seen provides really good returns. The hardest thing, again, is the underwriting piece because you can't compare it to other properties in the market. You can maybe use the market data to kind of find a basement price or basement revenue, but obviously the more unique the experience, the more you can charge. So I think it's a great idea. I think I would look out to make sure that I'm looking at markets that attracts the type of tenants that you're looking for that fit the profile of your property. But it's a great opportunity to kind of stand out from supply.
Awesome, great answer. We have two questions coming up now about short-term rental regulation. So first one being, do we know any software that can help identify short-term rental regulations, or do we have any recommendations on how to actually research those, maybe more manually if needed?
Yeah, there's unfortunately no software out there that does it. There are some sites online that will kind of give you high-level data. Airbnb, I apologize, gives you high-level data on it, and they kind of link you off to each municipality. The best service that I know that's out in the market that actually can help you do a deeper dive into the regulatory information for the city is the group that I alluded to earlier here when I used that heat map. Bear with me one second. Revity, the group I showed here. So check them out. I think it's revity.com. I may be wrong, but if you Google Revity and short-term rentals, they do a good job of actually sending analysts to dive into markets pretty deep on a really block by block basis if needed to get you all the regulatory information that you need. So if you need experts to do a deep dive on it, Revity is your solution. I know over time they're building out a database of regulations, but it does not exist yet. Your local property manager, if you're planning to use one, can be helpful. Calling the city yourself can be helpful. It's sometimes it's difficult. There's no doubt about it, but it's a lot of times it's worth the effort. And yeah, Chris just linked to them. It's revity.com.
Great, thanks. The next question about kind of the regulatory climate is, do you have a point of view on what the most common short-term rental regulation that is being considered or being enacted in mid-sized cities? The example this person gave is that many don't really allow them in the most desirable zones of the city. Is there anything else you have to touch on there?
Yeah, that's one of them. The ones that we're seeing some now more of too is if they do allow them, they don't allow a significant density of them in a certain market. So we've seen some areas where they don't allow multiple short-term rentals within like 300 or 400 feet of each other because they don't want those to become a nuisance to the community. So those are probably the biggest ones we're seeing. A lot of them are based around kind of noise and violations. Like if you have a property that's caused violations on numerous occasions to the community, that can be shut down, which again goes back to what I mentioned earlier. Is probably a good thing, right? You want to make sure that these are operating appropriately. They're not used as party houses and are attracting the right type of guest. So it's really noise restrictions, nuisance restrictions, and sometimes a little bit of a density restrictions where you can't have too many in the same area.
Great answer, thank you. So this next question kind of goes back to when we were discussing supply and the influx of supply. Is there any tool or any way to look at market metrics or market facts to really see which markets the supply is really growing in, or maybe markets that are more or less likely to be impacted by floods of supply in the future?
Yeah, we've launched a tool ourselves on data.rebu.com where you can dive into and see market level data as well. So if you go to data.rebu.com, you go to market data, you'll see, you'll type in Charlotte, for example, which is where we're based, and you'll see some of the stats that I showed you guys earlier here that will show you, what the breakdown is. So this is for all properties in Charlotte, 1,700 listings. You'll see kind of the breakdown of, what the saturation of each is. You'll see most of them in Charlotte are 1, 2, and 3 bedrooms. There's very few larger units here, maybe a couple that are over 8 bedrooms. And then we can also show you kind of over time how the number of average listings has changed in the market. So we're one of them. There's others as well. Obviously, we actually encourage others to use tools like AirDNA to confirm data. Really, anytime you're making such a big decision as turning properties into short-term rentals, turning your real assets into revenue generators, the more data points you can get, the better. So utilizing us, utilizing AirDNA, utilizing Revity to kind of get comfortable with the potential, we completely understand and support.
Great. So going back to something you said before, also, you threw in a little teaser and said that we're going to have some more amenities and fee data available soon. Do you mind disclosing some examples of different amenities we'll be sharing data on, different fees, things like that?
Yeah, absolutely. So a couple of things. One that was been highly requested, it was requested in another webinar we did a couple of days ago, was EV chargers. How many properties provide EV chargers and what are the results of those? Um, so you're going to start seeing those as amenities going forward. Others include just cleaning fees, how detailed the cleaning fees are, how much everybody charges for cleaning. We're going to make that more easily displayed as well, so you can start seeing what percentage of properties in this market, in the zip code, are actually, have started doing $0 cleaning fees, which is starting to become a little bit of a norm. How many are charging above my rate, how many are charging below my rate. All those impact revenue, and all those can be amenity and really revenue management strategies that can be implemented. So you'll see those going forward as well. But I'm really excited about the EV charger one because I have a Tesla and I never drive it anywhere because I don't know if there's a good EV destination charging station there easily. So I'm excited that we're going to be able to add that as an amenity filter and to see what that return profile looks like by having that.
Yeah, definitely. I know it's been a highly requested one, so excited to launch that as well. All right, so we have just a few questions left. One that came in is actually regarding property management. Do you mind going through some of the pros and cons of having a short-term rental managed by a local company versus a national or even international company?
Yeah, so they're great question. Local, they will understand the local regulations and the local kind of event and demand calendar better than anybody nationally could. It's just a matter of fact. A lot of the local ones may also be cheaper, charge a lower rate. So they'll probably be provide a little better owner support service, because you'll be one of a handful of clients and they'll have time for you and help you on a more kind of one-on-one basis. The national groups, they will be much more sophisticated in making sure that the property is distributed on all appropriate marketing channels. They will be more proactive in the revenue management strategies. They will make things a little bit more at ease for you. The way I would almost put it is that if you want some kind of hands-on experience and you want to be very close to the property manager, a local group will probably give you some of that more than a national group will. A national group will be much more hands-off, which really can be both good and bad. It really depends on your personality. If you want to set it and forget it, a national group will do a good job of that. If you want to be involved and want to have the property manager on quick dial and ask them questions, a local group will probably be better. The fee differences can be significant between local and national. A lot of the local groups, especially the smaller ones, are going to charge lower fees. A lot of times you get what you pay for. I'm not saying that's always the case, but a lot of times you get what you pay for.
Great, thanks for that answer. So the next one is kind of regarding the recent algorithm changes that Airbnb has said that they've put into their platform. I know you mentioned ways to make your Airbnb stand out previously, but kind of reiterating that as well. Do you have any tips to make your Airbnb stand out specifically in regards to those recent algorithm changes?
Yeah, I mean, if you can have your property identify towards one of their new filters, unique stays, campground, whatever, that always helps. Anything you can do to make your property from the way it's filterable stand out is good. Airbnb might drive prices a little bit lower for you. I would not make it a race to the bottom. I would make sure that I go above and beyond and provide the best experience that I can for my guests, because the reviews are going to be reflective of that, and that will allow you to charge a premium. So I would not make it a race to the bottom from a price perspective. I would really kind of go above and beyond to make sure that the guest has the best experience. The photos are as attractive as possible. Change out the listing cover photo on a continuous basis just to see if one performs better than the other. Implement some discounts as needed. But the last thing I would do transparently is make it a race to the bottom.
Great. And then final question here. So this person's asking about those markets that you stated are your favorite markets. Why is that? And what do you personally look for when analyzing the short-term rental market?
Yeah, I mean, again, their drop-to destinations, which historically have proven to be kind of the most steady and consistent performers from a revenue perspective. It's always been the case historically. Those properties have done the best. So when we look at properties, one, it's, you know, looking at our data points that we have to say, okay, this is where we're seeing a lot of demand. This is where we're seeing the highest rep pan. This is where we're seeing kind of the most continuous and stable seasonality. So that obviously makes the jump out, you know, data driven. There's also a human aspect to it. These are all areas too that me as a consumer of short-term rentals of Airbnbs, I want to stay at, and I would pay a premium to stay at. And really, at the end of the day, a lot of, you know, data helps tremendously, but a lot of about Airbnb and short-term rentals is creating an experience, whether that's the type of home, whether that's the location, whether that's the amenities that you as a guest would want. And those usually translate really well to everybody else. So if you create something that you enjoy, others will enjoy too, and they'll pay a premium for it. So a lot of those markets are places that I know I like to visit, that I know others like to visit, and that the data supports those actually, you know, being the right assets and the right areas to invest in.
Awesome, great answer. That was all of the questions that we had come through the chat. So that's everything from us. I'd like to say thank you to everyone, and then Amir, I'll hand it back to you to wrap it up as well.
Yeah, thanks everybody for joining. Hope this was informative. Hope you guys learned something today. Again, you know, our view on the state of the economy is that, you know, or sorry, the state of the short-term rental market is that we're just going through a phase where, you know, supply is outpacing demand. It's, you know, we saw an overcorrection in 2021 and 2022 based on, you know, the kind of pent-up travel demand, and now it's becoming stabilized. And I think it's just, you know, investors understanding that this is the new normal, that for us to make sure that we get the most out of these asset classes and that these assets, we need to operate them professionally and find the right property. So highly encourage everybody to do that. If you guys have any questions, please feel free to reach out to us, reach out to our tools, interact with myself or with our team on Twitter. And yeah, let us know what questions you have, and hopefully you found some value here.